What's going on, everybody? Welcome to another episode of Urban Chart Chats with me, Mr. Urban Stock Market, William Mills. And in this episode, we're going to address a little thing called RSI. That is the Relative Strength Index. So all you people that are into the charting or interested in getting into charting, stay tuned as I break this down. Now let's get to it. RSI, Relative Strength Index. The RSI is mostly used to help traders and investors identify the momentum of a stock or a position. It will tell you the market's conditions, give you some warning signals for dangerous price movements. The RSI's rating is expressed in figures from 0 to 100. Now, the rating system goes from 0 to 100, but what you really want to focus on is anything between 30 and 70, because an asset around 70 is considered overbought, which means it's basically being pumped or too much people are buying it, driving the price up higher than it's supposed to be. On the other end, anything near or under 30 is considered oversold. An oversold signal could mean that the short-term declines are reaching an end. They're coming to an end, and that a rally could be in the near future for that position. So just remember, an overbought signal could be a precursor to a possible correction on that position. And an oversold signal could be a precursor for you to buy into that position because a rally may be starting. Now let's break down what the RSI really means to the average retail investor in layman's terms. You basically want the RSI to stay between the 30 and the 70. That is a stable range for your stock's position once you are in them, and you should not worry too much if the positions stay within that range. If you are on the outside looking in, you want to essentially buy when the RSI is under 30, which, if you remember, means it's oversold or approaching oversold. And realistically, you can buy it under 40 if you're not trying to pinpoint and lock a specific play, aka buying for long term. You don't have to worry about every single point. Now, if you're locked into a position and it starts trending near the 70 or above, and you're truly day trading or swinging, then that is your exit point. But if you're truly going longer term, then you want to check the RSI charts on the longer term. So go out a month or more and check what the numbers are on the average for the RSI. Then that way you know when you are nearing your exit time. Hopefully this helps you understand the RSI indicator a little easier to make the quick decisions when needed. Remember, anything between 30 and 70 is the safe zone. Anything above or under, you might want to adjust your position, unless if you're going long term. So hopefully this helps you understand the RSI indicator a little easier to make the quick decision when needed. And if you're looking or need that learn and earn hands-on experience, hit the link in the bio and become an official Urban Stock Market member. Get the courses you need and also enroll to the Stockwave Network for only $7 a month to trade and invest alongside. Hopefully you enjoyed this video and it was informative to you. There'll be more videos on the way in the Urban Chart Chat series, but especially more covering indicators, all the different indicators when it comes to the stock market and investing. So stay tuned, give me a like, and spread the word. Thank you.